Someone has correctly said, in finance, trust is built on transparency. Always question what's beneath the surface. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we discussed about the acquisitions in detail and some of the manipulation technique used by companies to complicate the already complicated transactions. Let's continue that discussion today. In the world of retail, the Friday after Thanksgiving, known as the Black Friday, marks the unofficial start of the holiday shopping season. It's a day when retailers aim to turn a profit and they all go out with sales and advertisements to lure the shoppers into their stores. However, some companies like Tyco and WorldCom took a different approach to shop till you drop mantra. They engaged in lavish shopping sprees, acquiring numerous businesses throughout the late 1990s and early 2000s to boost their performance. While they appeared to be thriving, the reality was quite different. These companies had weak organic growth, which they masked through acquisitions and accounting manipulations. One key deception involved inflating the reported cash flow from operations. They consistently reported strong cash flow from operating figures, which reassured the investors and silenced the critics. But this apparent strength was largely a result of three techniques or strategies that enhanced and flattered the CFFO through acquisitions and disposals. These companies' shopping extravaganzas eventually came crushing down when their massive accounting frauds were exposed. In this chapter, we delve into the details of how Tyco, WorldCom, and others utilized the acquisitions and disposals to create the illusion of robust CFFO. Let's go to the first technique of this episode, receiving operating inflows through a standard business acquisition. In this technique, we delve into the world of acquisition accounting and the financial tricks that companies employ to boost their reported cash flow from operations. Many companies, especially serial acquirers like Tyco and WorldCom, often appear to have strong CFFO, which investors may interpret as a sign of operational strength. However, this episode reveals that a hidden truth. A CFFO is artificially inflated due to accounting nuances related to acquisitions. So we are on the first part of the chapter which we are studying. When a company acquires another business, it inherits its cash flows, including the collection of receivables and selling of inventory. Let's continue this part. These cash flows become part of the acquiring company's operations without any initial outflow from the CFFO. By rapidly liquidating these inherited assets and not replenishing them, companies can show an unsustainable boost to cash flow thanks to the accounting rules segregating the cash flow into different sections. Furthermore, let's discuss one more clever scheme employed by some companies during acquisitions. They temporarily abandon the collection efforts on receivables and pay bill early before closing the acquisition. This causes the CFFO to appear low in the weeks leading to the acquisition but abnormally high immediately after. Serial acquirers use this method to perpetuate the cash flow from operations boost with subsequent acquisitions. The cautionary tale of the Tyco, which acquired over 700 companies for $29 billion from 1999 to 2002, illustrates the consequences of relying solely on the CFFO. While Tyco reported the positive cash flow from operation, it actually had negative free cash flow after acquisitions, indicating that its operating cash flow wasn't as robust as it seemed. What can we look at for identifying something is wrong? First, reviewing the balance sheets. When reviewing the balance sheet of acquiring companies is a prudent and insightful place for investors and analysts, while precise assessments may be challenging due to limited access to the certain financial information, this analysis can provide valuable insights into the potential working capital benefits associated with acquisitions. The primary objective of reviewing these balance sheet is to assess the working capital position of the acquired companies. We need to pay particular attention to items like accounts receivables, accounts payable, and inventory. These elements can reveal significant insights into the reality and the financial health of the acquired business. If possible, perform a comparative analysis of the balance sheet before and after the acquisition. This analysis should include the combined balance sheet of the acquiring company and the acquired company. Look for the changes in the working capital components such as increase in accounts receivables or decrease in accounts payable. Consider qualitative factors that may not be explicitly reflected in the balance sheet but could impact the working capital. For example, assess the quality of the acquired company's customer base and the historical payment behavior of its client. This information can help estimate the likelihood of the manipulations in the timely collections. In summary, reviewing the balance sheet of acquired companies can be a valuable exercise in assessing the potential working capital benefits associated with acquisitions. While precision may be challenging, this analysis can help make informed decisions and gain a better understanding of how an acquisition may impact the financial health of the combined entity. Let's move to the next technique, turning customer acquisition cost into investment expenses. In this section, we delve into a more deceptive aspect of how companies exploit the accounting rules, especially the acquisition accounting loopholes, to manipulate their cash flows. While the previous section highlighted how acquisitions inherently boost the CFFO due to accounting quirks, we now explore how some companies use this accounting loophole in non-acquisition scenarios to shift the regular operating cash flow to the investing section. Let's continue the tale of Tyco. Tyco, a conglomerate with a diverse portfolio of businesses, including an electric security monitoring provider called ADT, serves as an example. ADT operated in the rapidly growing home security monitoring industry. Tyco generated new security system contracts through two channels in its in-house sales force and an external network of dealerships. These dealers were essentially independent sale agents who were not on the Tyco's payroll but earned a commission of about $800 for each of the new customer they brought in. What's peculiar is how Tyco accounted for these $800 payment to dealers. Instead of categorizing them as standard customer solicitation cost, Tyco considered them a purchase price for the acquisition of contracts. Consequently, Tyco recorded these contract acquisition on its statement of cash flow as investing outflow. This accounting treatment didn't align with the economic reality of these transactions. In reality, these payments to dealers resembled typical operating expenses more closely than they resembled business acquisitions. And thus, it would make more sense to record them as operating outflow, similar to how Tyco treated commission for its internal sales force. However, Tyco's deep-rooted acquisition mindset led to the confusion among its executives, and they continued to classify these payments as investing outflow. This accounting maneuver conveniently inflated Tyco's CFFO, but Tyco didn't stop there. The company went further, transitioning from aggressive accounting practices to outright fraud. The SEC, Securities and Exchange Commission, accused Tyco of orchestrating a dealer connection fee sham transaction between 1998 and 2002, leading to a fraudulent CFFO inflation of $719 million, $719 million. Here is how the scheme worked. For each contract Tyco acquired from a dealer, the dealer had to pay an upfront fee of $200 known as the dealer connection fee. To offset this fee and ensure the economics of the transactions remain unchanged, Tyco raised the purchase price of these contracts from $800 to $1,000. This change had no actual financial impact on the transaction's economics, as Tyco still paid a net amount of $800 to acquire these contracts. However, Tyco manipulated its accounting to make it seem otherwise. The company recorded $1,000 of investing outflow for purchasing these contracts while simultaneously recognizing a $200 inflow in operating section. This created a fictitious $200 inflow in the CFFO by suppressing the investing cash flow. In essence, Tyco created a creative accounting to deceive the investors and artificially boost its reported CFFO and earnings. This move crossed the line from aggressive accounting tactics to outright financial fraud. Let's move to the third technique, encashing the cash inflow from operation through strategic business sales. Companies use disposals to shift the cash inflow from investing section to the operating section of the statement of cash flow, essentially enhancing their reported cash flow from operations. This practice is the opposite of the cash flow shifting technique discussed in the previous section related to acquisition. Companies use disposals to shift the cash inflow from the investing section to the operating section of the statement of cash flow, essentially enhancing their reported cash flow from operations. This practice is the opposite of cash flow shifting techniques discussed in the previous sections related to acquisitions. Let's go to an example of Softbank. Softbank's two-way agreement with Gemini BB. Softbank is a Japanese telecom company entered into an arrangement with Gemini BB involving the sale of its modem rental business. Instead of recognizing the entire cash received as an investing inflow, the Softbank divided it into two categories. A portion was allocated to the sale of business, while the remainder was considered as an advance for the future revenue. This clever structuring allowed SoftBank to report a substantial boost in the CFFO. Example is of Treehouse Foods. In its acquisition of the private brands, Treehouse excluded accounts payable from the deal. This led to a higher purchase price corresponding with higher net assets. Following the consolidation, Treehouse benefited from the cash collections related to acquired working capital assets without incurring the usual accounts payable offset. Let's discuss one last example of one of the famous companies, Whirlpool. When Whirlpool acquired a controlling interest in the Chinese appliance manufacturer Heifei Sanyo, they segregated cash into a restricted account to cover the ongoing business needs. Payment from this separate account did not impact the reported operating or free cash flows since the statement of cash flow reconciled to the beginning and the ending balances of the ordinary unrestricted cash. Here comes the end of this episode along with its key takeaways. First, when a company acquires another business, it inherits its cash flows, including receivables and inventory. These cash flow becomes part of the acquiring company's operations without an initial outflow from CFFO. By rapidly liquidating these inherited assets without replenishing them, companies can show a temporary boost to the CFFO. Tyco's acquisition spree, where it acquired over 700 companies, demonstrate this technique. Tyco reported positive CFFO but had negative free cash flow, indicating that its operating cash flow wasn't as robust as it seemed. Second, some companies misclassify customer acquisition cost during acquisitions. Tyco, for instance, considered payment to dealers as a purchase price for the acquisition of contracts instead of recording them as operating expense. Tyco classified them as investing outflow. This creative accounting inflated cash flow from operation, creating a misleading picture of the company's financial health. Third, free cash flow after acquisition is a useful measure of cash flow when analyzing serial acquirers. This metric can easily be calculated from the statement of cash flow. CFFO minus capital expenditure minus cash paid for acquisitions. Thank you for listening to this episode. In the next episode, we'll delve more deeper into the world of acquisitive companies and their manipulation of key metrics. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.